All right, all right. How's everybody doing? Is there energy in the house? Good, good. Everybody's awake. But hey, probably to put some context kind of into our discussion, would be great to hear kind of as we all VCs that what's the kind of the sweet spot of your deal in terms of size and stage? Maybe Patrick, if you start.
Yeah, we started with, when we started investing in fintech over 10 years ago, we started with incubation and co-creation of startups. Then we launched an early stage fund, seed to Series A, and invested in 15 fintechs. And now we are on our second dedicated fintech fund, which focuses on scale-ups that have 4 to 5 million of revenues, recurring revenues. And we invest across Europe. Key aspects of our investment thesis are deep AI, blockchain, and cybersecurity technology applied to fintech space. And we very much value, and always have valued, capital efficiency in the way that we invest. We are looking to build a cross-border investment ecosystem and expand our investment across the rest of Europe. And we're doing that in partnership with the FINE project. It's an EU subsidized project to build more connections between all the different European fintech hubs. And we take an ecosystem approach to investment. So we tend to prefer investing in B2B startups, and we aid them with finding partnerships because of our connections with banks, insurers, and other players in the ecosystem.
All right, what about you,
Great. And at Anthemis, we're a multi-stage venture fund, investing broadly in innovation in financial services. So we invest pre-seed to Series D. So we have 3 main investment vehicles right now that we're deploying capital. A pre-seed fund that's dedicated to female founders. Our flagship fund, which is seed and Series A focus. And then we have a venture growth fund, which focuses on Series B+. I personally sit on the growth fund, so I'm looking at startups across North America and Europe as kind of the regions that we invest at Series B and Series C. Typically, those companies are landing around 8 million plus in ARR, very strong product market fit, and probably an enterprise value anywhere between 75 to 500 million. And our thesis is very much, I would say, embedded finance, how fintech touches everything. So kind of thinking about 10 years ago when it was digitalization in financial services, how has that evolved, and how do we think about financial services touching everything from the construction industry to climate to mobility, and really being able to drive value based on our ecosystem and the financial services connections and strategics that we have as LPs.
All right, and if we look at kind of the last 12 months, how has the deal flow been? Kind of like if we look at the quality and quantity of deal flow, everybody's kind of like talking about that it's so hard to fundraise, but how does it look from your point of view?
Well, it's taken a hit, obviously. We've seen deal flow drop by about 50%. We are starting to see that pick up again now as we entered into 2024 and more quality deals. But what's interesting is the way that VCs are looking at these deals has changed as well. So they're looking more for profitability. They're looking more for, if there isn't profitability, then they're looking for higher gross margins. But it's going to take a while, I think, for that to really recover. In terms of the valuations, they've also been cut quite a bit, particularly at the later stage investment rounds. Yeah, so it's not been easy over the last, certainly in 2023, it really cut off and was really bad for finding great opportunities. Yeah. Now it's starting to pick up, but it's going to take a while.
I would say for early stage, we've had consistent deal flow. I even just look at the numbers of fintech broadly. When you look at, in 2019, globally, there was about 12 or 13,000 estimated fintechs. And this year, it's estimated around almost to 30,000. So in terms of early stage, there's a lot of companies out there. Mm-hmm. And then we can have a discussion around who's able to fundraise and not. But there's a lot of founders still very excited about fintech that are starting companies. At growth, it's been very, very challenging. And that's because going back everyone wants to go back to sensibilities and invest in growth stage startups that they actually think can make a return as growth stage investors. And then number two, I think a lot of investors that maybe invested earlier on in now growth companies realize, okay, we need to keep these companies alive to actually grow into whatever their valuations or hit certain like KPIs or achieve some level of unit economics, where then it makes sense to actually go out for new external capital. So because of that, there hasn't been, I would say, in 2023, a lot of net new deals, but that's starting to change as well too, I would say, going into 2024.
Yeah. How many deals have you done like over the last 12 months to like really put it into perspective?
Two.
All right.
Over the past 12 months, yeah.
Yeah, and we've done two as well.
Okay.
We invested in Levenue, which is a Belgian revenue-based financing company, and we invested in a Turkish embedded finance company that's opening up access to the Middle East.
Yeah. And how do those numbers compare, let's say, 3-4 years ago? How many deals would you typically do?
We tend to be running more at 3 or 4, so it's about double that.
Yeah.
Previously.
Great. And kind of like, we talk about now the recent deal flow, and obviously, what are the key trends that you've seen? Kind of like, what's the kind of the hot topic in fintech right now, and what gets your attention, and are the winning deals?
Do you want to start?
Yeah. I mean, there's quite a lot. I think what we're seeing right now is this kind of evolution from the proliferation of like API connectivity in fintech, which saw the emergence of a lot of companies like, one of our portfolio companies is like Weaver, which is providing embedded finance or fintech solutions at sort of the point of need, and making sort of non-financial products, giving them sort of some type of fintech-esque or financial service on top of it. So we saw that. What we're seeing right now, and what I think we're getting excited about, is everything around sort of these like programmatic workflows. So companies, products that are providing sort of an invisible finance layer, where everything is fully automated, fully contextualized, where it's operating in the background and you just don't even know it. And so that's kind of, when we talk about, everyone's saying AI or generative AI, and everyone's like, what does that actually mean in the context of financial services? Okay, that's very, very challenging on many levels, but that's something that we're really, I guess, interested in, because we think we're at a inflection point where it's going to actually broaden the scope of, I guess, ICP that fintechs can target in the future. So as an example, one exciting, I think, thing that we're looking for at the early end growth stage is, how do we sort of reduce the lending gap right now in fintech? Banks, lenders have always struggled with maybe lending to an SME because they have a very thin credit profile, or even for a consumer that their credit score, or it's hard to KYC them in an effective way. Can generative AI, with the output of that data, empower lenders in the future to do more effective financial analysis, to do more effective KYC, credit scoring, to lend to people that were unlendable 5 or 10 years ago? And so, as we see sort of this new, I guess, wave and generative AI sort of taking over the planet, these are some of the opportunities we see, going forward in the next few years.
Yeah, absolutely. What about you, Patrick?
Yeah, I mean, it's very interesting when you talk about the programmatic nature of and using data and open banking to provide different pieces of the whole puzzle. This we see has been happening in blockchain for a while, and you get all these specialists that are specialize in staking and decentralized exchanges and building stable coins and all those kind of things. And we see now banks are really acting now to take on board these technologies. They want to replace, over time, it's going to take a while, but they want to replace their payment rails, they want to tokenize assets, they want to issue stable coins, they want to do all of these things, and they're very active doing that. So in France, for example, where we're based, we got BNP Paribas and Société Générale building projects. Société Générale has a project called Forge, which is looking at how to tokenize assets and launching a stable coin. And actually, at the same time comes the biggest challenge with that, which is the interoperability of all the different blockchain solutions. So when we're seeing startups in this space that are doing great things, it's always the same challenge that they have, which is how do we get the interoperability so that we can actually put all of this together, because the real power comes from fitting everything together.
Yeah, yeah. How do you actually see, would the European regulation help with that, or is it kind of industry-driven, or what would be driving that? Like, what would be the driving force there?
A lot of it really is kind of is technical. I guess the regulation has a positive effect in the sense that it's protecting consumers more, so, and companies as well, users of these solutions. But at the same time, it's creating constraints on some of the players. That'll cut out some of the wheat from the chaff from the wheat. But then it's creating also an issue for people creating stable coins, for example. Those that want to create a stable coin in Europe under the MiCA regulation, they have to meet certain criteria, and that means keeping a lot of the value of that stashed in a bank account in cash, basically, in deposits. And that's leading to some players like Tether actually thinking about, well, do we want to operate in Europe at all? We've got decentralized or exchanges like Kraken and so on who are delisting Tether already because they don't think they're going to meet the requirements. So regulation is a mixed bag, but yes, it's going to help improve the adoption, but at the same time, it creates also technical, more issues for the players.
Yeah, absolutely. Well, ESG has been, the three letters on everybody's lips. Kind of how do you see ESG coming into the finance, and how has that impacted kind of like the deal flow and your companies?
Yeah, I mean, I kind of think about it in two different ways. How, financial services, firms or institutions are thinking about their own reporting and keeping themselves, I guess, as active players in the fight to net zero. And then kind of what's broadly happening in carbon markets, what's broadly happening in sort of that intersection with climate and fintech. So on the first, I think there's a lot of impact frameworks and ESG frameworks that a lot of fund managers are using, either because they want to or their LPs are demanding it. What's the problem currently still is most of it's not very standardized. So there's no way to sort of benchmark at scale between a lot of fund managers, like how's impact actually being made, or what does one LP want versus the other. And there are companies like in Europe that we've looked at, even at growth, that are trying to push, when you think about broader sort of financial services or asset managers, some type of standardized methodology or framework across the industry to report on ESG, so that going forward, we kind of keep each other accountable. So I think that's yet to see how that actually plays out over the next 5 years, but it'll be really interesting. And then on the carbon market side, I mean, there's just so much talk around sort of, let's say, credits, and it's getting out of control because everyone's trying to procure them, and there's always this conversation around quality of credits as an example, and there's a lot of greenwashing out there, and so going forward, there's going to be much more of a sort of a magnifying glass on transparency and traceability as the carbon markets evolve, specifically the voluntary carbon markets, as a means to get there for corporates and institutions alike. And so I think what we're getting excited about is not necessarily what's happening in voluntary carbon markets, because the market right now is actually quite flat. It hasn't grown over the past 3 years. But what are the sort of technical rails that are going to enable this market to grow, so that the broader financial services industry can then actually start doing something with it.
Yeah, I guess it's probably easier kind of the E and G category, but anything on the S, kind of the social side, have you seen anything interesting there?
Well, it's interesting you ask, because as a fund, we are labeled Article 8, and we're looking to move towards Article 9 potentially. In fintech, when people say, what's the ESG impact, actually I see most of it is in the S. I mean, it's true that in terms of fintechs that are helping orient investments that go into green areas and so on, then there's a lot of value add there. But in terms of many of our fintech investments, it's actually companies that are driving financial inclusion.
Yeah.
And they're driving financial inclusion of individuals, of companies. In Africa, we have a remittance company that's really, enabling better support for families over there, etc. So I would say like 90% of the companies in our portfolio are all driving financial inclusion in some way. For example, SMEs getting access to finance quickly. Gen AI is just accelerating the capability of many actors to be able to do that.
Absolutely. Maybe coming back to the AI topic, Gen AI topic, are there any kind of cases in the deal flow that don't include AI, or has it kind of flipped already to that size?
In my view, they should all be using AI in one way or another. From two perspectives, maybe not in the core technology, but to start with, but still it needs to be exploited. But definitely in all their operations, when you consider in this current environment where it's difficult to raise funds, VCs are looking for, investors in general are looking for better gross margins, efficiency and all those things. If you're not already exploring every way that you can leverage AI to improve your marketing, your coding, your everything, then you're already falling behind. So you absolutely need to be doing that, whatever.
I would say they should, but it's difficult still to do such, just because there's still a precision problem. So precision of data, and so that's the data that's actually being trained on, and then the output. Because we can't get to a point where we're starting to slack on the integrity in financial markets, and that's like the utmost importance. And so when we think about these complex systems that banks and et al. Work on, it needs to be integrated at a way in which aligns with the existing infrastructure and workflows. And so everyone should be doing it, but I think the industry is going to be very slow to adopt it, because we can't risk to mess up, and then there's too much risk aversion to do it anyway. And so it's really figuring out how does this actually going to be implemented in the most effective way.
I totally agree with you on that. I think that's a really critical thing. And one thing that concerns me is that AI is potentially going to dumb down kind of humanity, where we kind of just take what it says and then reality gets distorted. So definitely the use cases in fintech in particular are going to be for knowledge workers, expert workers, who use it to accelerate probably the beginning of or somewhere through the early stages of their work, and then they are double checking, refining and completing it. And that's how I'm seeing it being used mostly at the moment.
And I think, of course, like EU is working on the responsible AI, the whole AI acts that are probably going to be kind of interesting to see. At least the lawyers will benefit a lot from that work. But and obviously super important for the financial inclusion that you don't have any sort of a pre-built bias built into that. And anything interesting that you've seen in the kind of regulatory tech space that kind of cases that you've looked at? Or is it probably not?
In RegTech, we've seen a number of players. I must say recently we haven't seen very much coming out. And actually a lot of our focus really is very much more on things like embedded finance, blockchain, and just more generally. Let's put it this way. It's very easy to say there's XYZ sector in fintech that's really hot, and that's where everyone's investing, so that's where you need to be. But actually for us, it's about finding the outliers in each of those sectors, because there are always outliers. And even though there's a big fintech in that space, there could be a new technology, new application of AI or blockchain that will give them that other advantage. So, yeah.
When I think about if I bring up Weaver again, I think the beautiful thing about their product is And what I think customers want is just a very seamless experience. So you do provide an embedded, fintech solution, and that comes with everything. Also, it's compliant. It's already compliant. It's already fits within whatever the regulatory regime that you may be operating in. And so I think from a reg tech perspective, it's maybe not specifically solving this specific regulatory problem, but I want sort of the full package offering where I don't even have to think about it. It's kind of just I buy your product and it's already solved for me.
Yeah, yeah. How would you see in that embedded space, kind of like who would be the key players, and will it be kind of like winner takes it all market, or how will it play out in that field?
I think it really depends, and I don't believe it's going to be a winner takes all market because it's going to be very bespoke. It's going to be very specific to the industry. The built environment has different needs for an embedded product than if we look at some product or companies in climate or some companies maybe in mobility. So I think it's going to be more industry sector specific, and will there be a few select winners in that space? Yes, but then you're talking about $100 trillion economy, that global economy. So the opportunities are still very massive.
Would you agree with that view?
Yeah, I mean, I was just going to rebound on the AI topic, because in our deal flow, the most recent investment that we did is in Revenue, and they leverage AI technology for faster onboarding of their customers. So they do revenue-based financing. They are validating the solvability of those customers. They're doing credit scoring, and all of that is actually enabled in the initial stages by AI in order to accelerate that.
Yeah, yeah. So you see a huge efficiency gains kind of compared to the existing players. And yeah, what about, we've been talking about trends, but then challenges. What do you kind of like, is it mostly that this is worrying for the old incumbents, but what's kind of like the biggest dark cloud that's looming out there?
Well, I guess I'd probably go back to blockchain, and the banks are scrabbling to get it on board, as fast as they can. It's still a wild west out there. I really agree that the MiCA regulation is really good in Europe. It's one of the more flexible. It's been seen as a shining example of a good way to regulate in this space.
And obviously, do you think it kind of brings credibility to the market? And,
yeah, absolutely. I mean, and then that's what drives the confidence in the end users and so on. So yeah, that's the kind of the dark cloud. It's taking its time to set in place. It's not like it's gonna kill finance straight away. But what I see is the banks really making an effort to take it on board properly.
Right, and so it sounds like you're optimistic about kind of the blockchain. It was like a little bit of a topic that was avoided. Maybe there was like obviously the token side. There was a little bit of a crypto winter and everything, but you kind of say that's
yes,
coming
absolutely.
out.
I think particularly the things that kind of saved it in a sense is tokenization and stable coins, and those are things that are closer to the activity of banks that they can immediately start to see how can we start building stuff on this, and then of course it'll expand to the other applications.
Yeah, absolutely.
I mean, I would say the near-term dark cloud is the lack of growth funding. So if we look at in 2021, kind of that demand to supply ratio was 0.6, and now if we look at this quarter 2024, it's 2.4x. So we have a growth capital problem now for fintechs. There's not enough growth capital to meet the demand that's going to be emerging over the next 12 to 18 months. And that's just because of a lot of dynamics over the past 2 to 3 years, of course. And so if that's not solved, a lot of these very high potential companies are really going to have to figure out how to do more with less, which isn't necessarily a bad thing. But we really have to start thinking about how do we start positioning ourselves as the venture community to meet that demand going forward.
Yeah. And probably to open a little bit, like where do you see the problem is? Because everybody's probably thinking that we're just sitting on a big bucket of cash, and why it's not happening?
That's true.
Well, yeah, I mean, M&A has gone down like 70% versus 2-3 years ago. And so what we see is a big issue for investors to get the exits and return the cash to the LPs. That is what then gives the LPs the confidence to then reinvest in the next round. And so what we find is VCs, for example, are struggling to raise the next fund. And so they're being super careful with the fund that they have now, and they're trying to do exits. Yeah. And what we're seeing is a rise in secondaries market, which is starting to explode, where VCs coming to the end of a 10-year fund, they have to get rid of these assets, they have to return money to the LPs, and the best way to do that is via secondaries. And now we've got specialized actors appearing who focus on investing in secondaries and facilitating secondaries, and investment banks that now are focusing very much on secondaries as well. So that's a big shift.
Yeah, absolutely. And I guess we were talking about also like GP loans there in the back room, so kind of
also
interesting
something
time.
emerging.
Yeah. Yeah.
Actually, we're seeing some venture capital term sheets are including a clause whereby they would have the right to exit and do a secondary basically on their shares alone in the company they invest in, if it's in the context of a portfolio end-of-life secondary scenario. So they're already anticipating that. So watch out for that in the term sheets.
Yeah. What about kind of like, you have a crystal ball that, is it now in 24 that we could see the exit market opening, IPOs happening again in more numbers? At least there's been some, but obviously it's been very quiet. So
I'm holding out for another year.
Yeah.
I think even when we look at our portfolio, there's starting to pick up inbound M&A. So I do think that's going to be first, and then the IPO market slowly opening up into 2025. But yeah, we'll wait and see.
Yeah. Wouldn't you think that this might be a good time to consolidate companies? So if you have kind of like, you would think that kind of like if you're building a portfolio of things, kind of low valuations, and is it still the lack of capital that is kind of preventing that from happening, or what's the lack of appetite there?
Well, we have seen many actors, industrials, taking advantage of the situation and looking to get good deals and consolidate. We've also seen situations where if one leading fintech in a space is acquired, then suddenly that creates a lot of interest to acquire one of the remaining ones before they all disappear off the market. So one example is in e-invoicing in Europe. Regulation is coming in, rolling out across Europe, and in France it's arrived. And so there was a big player at the top of the market acquired, and then suddenly we got inundated with requests to, for an M&A deal on our e-invoicing startup in the portfolio. So yeah, there's definitely people looking to do that.
Yep.
But I think consolidation is kind of inevitable anyway, because the way forward and to keep growing in here, often the fintechs, they start with a particular focus and then they just keep adding the pieces on. So, and now we have started to see that happen.
Yeah.
Any in your portfolio companies, do you see that?
I think it's inevitable. I think it's too early to tell, but based on the activity that we're seeing, I think there will be some level of consolidation over the next couple of years.
Yeah. If we have fintech founders in the audience now, kind of like seed stage or very early stage, what would be your advice?
I'd say you've been kind of saved from a lot of the downtrend in the valuations. There's still a lot of hot interest from VCs to invest. So that's a great thing, and
Yeah,
I just keep at it. I mean,
yeah, I think timing is great. This is a great year to be back out and doing it. And I mean, my advice would be really think about and communicating kind of what's that next wave of fintech that's going to change the world. How your company is going to do that? Because a lot of people are thinking when they hear fintech, they think about what fintech companies are doing still in 2010 or 2014. And so really helping an investor appreciate, what does that look like in the next 10 years and how you're positioning your company to really, go after success.
Yeah, and I would also say just bear in mind the sensitivity to heightened sensitivity to risk by investors. And as is always the case, you need to look really strong on the unit economics. So again, demonstrate how the gross margins and all those kind of things are going to take you towards profitability eventually.
Perfect. I think that's a perfect note to end our panel. And thanks,
Thank
Jeremy.
you.
Thanks, Patrick.
Okay, Tom.